My goodness gracious, it is December. That's letter X for you commodities folks out there. December 2nd. Guy Adami here. I'm joined by Dan Nathan. This is Market Call at 11 a.m. Eastern Time. Every Thursday, we break down a few macro calls. We highlight the biggest analyst calls of the week. And of course, Butters. One for the road, man. I got to tell you something. I dig that cat. Joining us each week would be the great Carter Braxton Worth from Worth Charting, and of course, Liz Young from SoFi. Today's market call brought to you by our three presenting sponsors: FactSet, financial data and analytics powered by tomorrow; SoFi, get your money right, all in one app; and of course, Open Exchange, because they manage virtual meetings that matter for the top companies around the world. And check this out, December 8th, 12 noon, live market call. 2022 outlook. We are talking earnings, energy, and ESG. Join us for a live 30-minute discussion on these three key themes. Sponsored by FactSet. Dan and I will be joined by FactSet's best and brightest, the aforementioned Butters, senior earnings analyst Elliot Karoum, senior product manager at True Value Labs, and Catherine Miller, president of BTU Analytics. How are you, Dan?
I'm doing great, Guy Adami. There's an expression that you hate when it comes to markets, that it's a stock picker's market, right? No, I know. I'm not even going to do that.
I woke up in such a good mood, and you're bringing me down. You know
right.
Who doesn't bring me down? It's the great Liz Young. And before Liz comes in, we'll bring her in. But there was a great Dave Edmunds song. It was written by Graham Parsons, 1979. It's called Crawling from the Wreckage. And when I saw her note about a feisty market, that song popped into my head. So Liz Young, how are you?
I'm great. How are you?
You're saying to yourself, I'm highly educated, highly intelligent. I got this great job, and I got to be on with this bozo guy Adami every Thursday. I can see it in your head just spinning around.
No. I get to be on with this guy Adami every Thursday.
There it is.
It's great to have
I'm ready
you on.
for
And,
it.
your note, you're talking about feisty markets, and since basically last Friday, and maybe even before that, things have been feisty. So talk to us about your note, because you're talking about the most wonderful time of the year. That song makes me crazy, by the way, but let's hear it, Liz Young.
Oh, well, first of all, every note that I write in December is going to be about a Christmas song. So I'm going to drive you crazy through the end of the year. So let's start with the idea that we've had three big down days, right, in four. And that feels really dramatic. It's going to feel really dramatic to everybody who's a market participant. The reason that I took this approach with the note is because there are times when I would say to people, sit on your hands, don't do anything, wait this out, let the dust settle. This is not one of them. This is a time where you can choose one of two paths. You can act, you can be nimble, which is what I would suggest, or you can kind of wait around and see what happens at the end. Now, the reason why I would say don't sit on your hands is because we're coming into the end of the year. We're still in a seasonally strong environment, and this is not the first variant, won't be the last variant that we see. We've lived through this before. Delta was really scary in July and the beginning of August, and then it got much less scary as August went on. Now, I know this one could be different, but you have to look around, and at the end of this, I'm gonna take the end and start there. See the forest before choosing your tree. So what I mean by that is step back, look at the whole picture, and try to decide where you need to be nimble. Get your feelings out of it, if at all possible.
Before we get to Dan Nathan, Liz, just let me tell you folks who are considering this. A lot of people like to go out in the forest and cut down their own tree. Those trees are about 10 times heavier than the trees you buy at like your local supermarket. So although it looks great in the movies, it's really hard to do in real life. Dan Nathan, please chime in.
Yeah, and so what I was going to say, though, Guy, it's like, that whole stock pickers market sort of thing. This is actually a trader's market right now. And I think to Liz's points about feisty markets, it's just not equities, right? There's a lot of other things going on, the moves in commodities, the moves in FX, the moves in rates. And I think it makes sense. Her strategy makes sense here. And it makes sense to talk about this after such a monster year in the stock market. The S&P is still up 20% on the year, despite being down, 5.5% from those all-time highs made last week. And I think Liz's points are really important here, because you have to start thinking about, Liz, how you want to be set up in 2022. Just because 2021 we climbed a wall of worry, that's another thing that triggers Guy Adami. But it really makes sense to start thinking about how you want to take 2021 positioning into 2022. Is that correct, Liz?
That is correct. And I'll give you two quotes to choose from, and then I'll tell you which one is right and which one is wrong. The first one is, dance with the one that brought you. The second one is, what got me here won't get me there. Okay. The first one is wrong. The second one is right. And that's how we get to set up for 2022. So when you look at what got us here, it's a lot of tech. It's a lot of, the yield curve is going to stay low. The yields are going to stay low. The yield curve is going to stay flat, right? I don't think that's what's going to happen in 2022. We heard a very clear message, poorly timed message, but a very clear message from the Fed that they were going to probably speed up tapering. And we saw the market react and say, you know what, we don't really like that message, but we better get used to it. And rate hikes are probably coming down the pike in, let's say, summerish at best. Okay. So there's going to be this sort of regime shift economically, this policy shift, which isn't going to go unnoticed. And there's likely a leadership shift that comes along with it. It doesn't mean that there's no leadership altogether. It means that there's a leadership shift. So there's a couple of things if we want to get really specific about where I think you need to be nimble. And on these dips, I said in the note, scoop up these dips. So where do you scoop? You scoop in the places like industrials, ex-airlines. I'm not super excited about the travel industry right now. Obviously, we have lockdowns from abroad, so international travel is going to suffer, unfortunately. You look at consumer discretionary, but stay at home. I think the stay at home thing is played out. Nobody's going to want to do that anymore. We're going to resist it in the US, but I think the consumer is still very strong. I think energy should get a bid here. I still think small caps should get a bid. And I think that you have to still look at financials. We believe that the yield curve is going to steepen, and it should steepen once some of this fear disappears.
And I think healthcare was another one. We're going to take a look at, obviously, this energy, but, energy is interesting. Healthcare is another one you mentioned. Energy's been a tough slog, though, and good kudos for Dan Nathan, who's been talking about this, the great CBW as well. It's been tough to stay long energy. I mean, crude's traded off the commodity $20 in about a month or so. That's a pretty dramatic move, Liz.
That is a pretty dramatic move. So some of it probably warranted. I mean, energy is the best performing sector of the year, so maybe it was a little bit frothy. But now you have to sit back, and this is where you see the forest before choosing your tree. Sit back, look at the forest and say, okay, but now we've corrected to a point going into winter, even if winter's warmer, right? Yeah. We've corrected to a point where there's still going to be demand that's probably above where energy sits right now. And if we have maybe some lockdowns, reduced activity, there's going to at some point be a surge in activity and demand for energy.
So Liz, let's talk a little bit about bank stocks financials. I think we have a chart of the XLF here. And, one of the things, and I know that you try to get to the important part, just like on your monthly podcast for SoFi, but the important part of what's going on with bank stocks, like you said, is that yield curve. You expect it to not be, flat, all right? You expect it to expand. But what are we seeing right now? Investors have moved in the 2-year yield, right? And we're seeing that north of 60 basis points, and we're seeing the 10-year can't get out of its own way. So the near term, investors are taking matters into their own hands, saying that the Fed they're acknowledging the fact that they're going to be raising or tightening monetary policy, but longer term rates are saying that growth, right, may not materialize the way that a lot of rosy economists are expecting. So that doesn't seem to be a great scenario for bank stocks, but they hang in there pretty decently.
Yeah, I think they hang. Well, you have to split bank stocks up too. I mean, there's bank stocks that are more exposed to the consumer. And when you think about just a lending picture, if we're lending in a healthy economic environment, and I think we're going to have to in 2022, there's going to be more consumer lending that occurs because, people were sitting on this big stockpile of savings, but at some point that runs out. So in order to keep spending, there has to be lending, right? So when you look, I did not mean for that to rhyme. That was a pure coincidence. But when you look at then what happens to banks, their revenue is on the long end, their cost is on the short end. So clearly right now they're under pressure from a net interest margin perspective. But when you get into 2022, as that yield curve steepens, and not even just the yield curve steepening, think about what actually affects financials. When the Fed raises rates, the prime rate goes up, and that's what they lend on. So that's where things start to really shift. And I mean, we're probably going to get a rate hike in 2022 unless some catastrophic event happens in the first half. So I think as we get into the first part of the year, January could still be a little bumpy, but let's say we're in the middle of spring, early summer, yield curve probably steepens and stays steeper, and then you get a rate hike. That's good for financials.
I love those two cats behind you. I mean, they're dying to turn around and wave. I mean, I would call them, but that's just me. I love your work.
There's three of them now.
I think everybody should follow you on Twitter.
We're drawing a crowd.
And follow Liz Young at Liz Young Strat on Twitter. Sign up for SoFi's daily newsletter at SoFi.com/daily to read Liz's articles every Thursday. Liz, parting words. I don't want to hear any more Milwaukee Brewers stuff because they've done nothing. Now we're in a work stoppage. Talk to me about the feistiness of the market and how you're embracing this volatility, not running from it.
I'm gonna give you parting words the same way that I closed my column this week. It's a quote from my dad. If it were easy, it wouldn't be any fun.
Ain't that the truth? It's like being a Met fan. Well, thank you, Liz Young. Enjoy the rest of your day. It's always great to have Liz on. Now we're going to bring in CB Dubs. Carter, how are you? We've heard from Liz Young. You've heard what we've been chatting about. Sort of opine quickly.
So, well, you got a lot of subjects up there on the board. I'm a little bit in the opposite camp. I really don't like small cap and I don't like value and cyclicals. I think that those were beloved. We know that, in fact, and there's no way around this. In March, the 3 and 6 month spread of the Russell 2000 versus the S&P 500 was the widest ever recorded, going back to 1978 and the inception of the small cap, which is to say people were playing cyclical, beta, small cap, playing reopening trade and so forth. And yet, obviously, it got a little ahead of itself to the point where the spread with the S&P was as wide as ever measured in some 30, 40 years. And what's happened since, we know, is that big sideways, range bound. This could be the transports, this could be the small cap, it could be the KRE banks, it could be the Russell. And then, and this is insidious, the breakouts that failed. The Russell did break out. And there are a lot of studies that show that a stock or commodity that does break out, that draws in a lot of money and buying interest, that then starts to reverse, the money that, the pressure, the buying pressure, the capital that caused it to break out becomes an accelerant on the way down as that money pivots and says, my God, it's not working, let's get out. Not to mention the people who never acted in the first place just say, maybe I should reduce this. So I think one is right to be in large versus small, in growth versus value, in tech, healthcare versus cyclicals. I mean, this chart of the Russell, I mean, that is a false breakout. Now, to be fair, it's also hasn't violated the lows. But at the end of the day, the Russell is making new relative lows on a one-year basis to the S&P. So too is the S&P 500 pure value index. I think this is all harder work than staying with, let's say, Microsoft or Apple.
No question about it. I mean, this one, by the way, you were spot on this one. I thought incorrectly, I thought we were going to go sideways for a while, which we did. I thought we'd break out, which we did. But that false breakout is really alarming. And I guess in terms of the RUT here, you look at it, we are at critical support. And one has to wonder, CB Dubs, if we break through the downside, is it going to be just a matter of time before the S&P follows suit?
Yes, I think that's a pretty good inference to make. Another way to say it is to and look at this fact set. We're talking about good colors and very clear annotation. This chart is depicting the 3 unfilled gaps that, now there are others going back further, that's tomorrow's lunch, but here and now, it takes a lot of euphoria to cause an index to gap up at the open. So many stocks are so well bid that they're actually a gap left behind in the chart, which is to say no stock traded at that level. And I think we're going to retrace right down to 43.72. That'd be about a 4% decline from here, which would represent basically a peak to trough of 7-8%. That's perfectly reasonable. In days gone by, years gone by, that was called a dip, a correction, a pullback, a drawdown, a sell-off, a decline. They're normal.
Yeah, hey Carter, I've been tracking those gaps that you've been talking about on Fast Money and on Market Call over the last couple of months. That makes sense. Another thing that we've been tracking pretty closely, we just had that discussion about the 210 spread. Let's talk about 10-year yields. How do you think this resolves? Because in a lot of ways, we've been talking about the range that the 10-year yield has been in, very similar to the way that we've been talking about the Russell 2000. It is well defined. It's been banging around between these levels. It did not really have a breakout, but we are retesting that uptrend from the summer lows here. How do you think that resolves itself, and what do you think it means for the stock market?
Yes, so and this is in many ways the biggest subject of all. Before addressing this, it's important to know that right now, I mean literally right now happening, that the 5-30-year spread is collapsing. It's below its COVID low, except for one print on one day. I'm in the lower yields camp. I think this is also consensus is higher yields. And while it's not good to just be contrarian all the time for some sort of lifestyle, sometimes it's very right to be contrarian. And the consensus is rates are going higher, and that's not the message of the 10-year yield. It's not the message of real rates, and it's not the message of the 5-30-year spread, not to mention other spreads. Lower.
You brought some pretty cool charts with you. The MSCI World. Talk to us about this, Carter Braxton-Worth.
All right, so let's take a look at this. When this comes up here, we've got two charts. If we can, let's toggle back and forth. That's the world index. Let's go to the next one, and we're going to go back and forth, before and after. Now let's go back to the first one. All right, what do we got there? The first one is the MSCI World Index, and I've annotated May 10th, that dotted vertical line. We're much higher than we were on May 10th. Yes. Now go to the World Transportation Index. Look at May 10th. We never could make a new high. Dow theory, which has been ridiculed, embraced, adored, it says in simply this, that if one index is in an uptrend and making new highs, it must be confirmed by the other. And this is the definition of non-confirmation. We have a double top. The transportation average did not make a new high. It never could get above its May high. We're about to be December. If we go back and forth one more time, quickly, there's the whole world up and to the right, and the transportation index with all the boats and planes and trains, trucks, no new high. Not good.
Yeah, so Carter, let me ask you this. And it's interesting that you brought the MSCI World Index. What do you infer about the U.S.? Because if you talk about transports, we know that the U.S. is obviously been a lot better than some other parts of the world, the way that they've come out of the pandemic here. And the hope, I think, was that we would see some of the developed world and Europe start dealing better. That's not been the case here. Bringing it back to the U.S., is this problematic here? Because we did have a similar move in the transports, and it did not confirm all of those highs in the S&P 500 here. Is this a really bad setup for stocks heading into 2022 after what right now, let's say the market closed here, the S&P's up 20% and the biggest peak to trough decline is 6%.
Right. So it's a very benign year, despite what on any given day might feel a lot of excitement. I think the setup is as follows. We're having upgrades in oil to $120 a barrel, and oil collapses to 63. We have strategists, and it's their job, I get it, to put their year ahead targets, stumbling over one another to raise their targets, and yet the market is saying something different. Rates going to 2.25, but they're stuck at 1.4, and spreads are not. I think it's so overwhelmingly complacent, bullish, calmly confident. The messaging here is that something else is coming for 2022.
First call we got to look at is Apple. I mean, a couple months ago, they warned about, potential shortages and weren't going to be able to meet demand. Well, now they talked about slowing iPhone demand. Oh my God, I thought everybody wanted an iPhone. I thought Apple was the greatest thing ever. That's me being sarcastic. That's for another show. But Dan, Nathan, they're saying weakening demand into the holidays. It's going to be interesting to see what happens to the stock. I know Carter has some thoughts. I'm surprised it's not lower than it is. But Dan, Nathan, what's your take on Apple? Because I think the average price target now is approaching $170 a share.
Yeah, let's just talk about the fundamentals here. I mean, I think this whole notion of these like super cycles, these upgrades cycles. That seemed to be a big theme over the last 10 years. We know that iPhone makes up, 65% of their sales, and iPhone growth is really important for their services growth, right? And the services growth is one of the main reasons why the stock has been re-rated from about 13 times, about 27 times. Its multiple has doubled over the last couple of years or so, and it's now become the biggest market cap company in the world, or it has been for a while, and it toggles back and forth between Microsoft. This is not a huge surprise. Again, was 5G supposed to be this super cycle? I don't know if you guys, I look down on my iPhone, it says 5G. It doesn't feel any different than the speed when I said 4G or even 3G a couple years ago. So to me, I think that stuff is a bit of, you would say, Guy, fugazi. I think, though, if you want to extrapolate this, right, and they're saying they're warning their suppliers, right, unless you hear this from the company, that this is the start of chatter you hear all the time. You want to go, who are their biggest suppliers, right? Well, one of them is Taiwan Semiconductor. They get 25% of their sales from putting their phones together. Broadcom, AVGO, also about 20% of their sales. AMAT, obviously, it makes equipment to make semiconductors. That stock's getting hit. That stock's getting hit harder than Apple is today, So to me, I guess the concern, and I'd love to get Carter's take on the charts, is that this stock went from a massive underperformer to a massive overperformer in a very short period of time, and it's gone up seemingly 15% in a straight line, gaining, hundreds and hundreds of billions of dollars in market cap. And I just not think that's sustainable from a fundamental standpoint. But Carter, I'd love to get your sense on the charts here.
Yes, please. So two converging lines, which is so often the case. And we can see there that Apple was able to break out. And now news-related drop back below the upper line. The important part, and it's exactly what you said, Dan, that upper red line, it starts back in September, a year and 2 months ago. Apple's spike and blow off top there, and then it drops some 25, 30%. It spent a whole year underperforming the stock market, underperforming Google and Microsoft. And it was only recently that it started to show some life. And I think despite its news-related drop and gap today, truth is, the action intraday is exceedingly bullish. Yes, it dropped in gap. Yes, but if you're a company that essentially has one product that everybody knows, and your flagship product, you come out and say demand's not so good for it, and the stock is down $2, $3 on a $165 stock, I think you want to stay in Apple.
Yeah, it's pretty remarkable. I mentioned on Fast Money the other night, we traded Apple typically trades about 70 million shares a day. I think it traded about 175 million on one of those big up days. So you clearly have people piling in for whatever reason. Maybe it's the weakness in the broader market. Maybe it's some flight to safety. We'll see if that volume is sort of an exhaustion of buyers. That remains to be seen, but your work in this is spot on. But you can't look at Apple without some of the comments without looking at the SOX, which is our next chart. That's the Philadelphia Semiconductor Index, CB Dubs.
Indeed it is. And here too, what nice colors and what good reference points. This, as opposed to the transportation index, or as opposed to banks, et cetera, and so forth, did break out. And that's the important thing. Some things get stuck. Amazon's still stuck, having not broken out. Some things have breakouts that are false breakouts and reverse the Russell, and some things do break out. And so it speaks to relative strength. Just as Apple has fallen back, and I think it's an opportunity, if and as the semis drop back to or even below the upward sloping top converging line, I think you buy into the weakness. Semis are not quite the cyclical area that they always were. They're so much a part of the ethos of the world that I don't think they have the risks that they've had in terms of their cyclicality.
Yeah, it's interesting. I mean, clearly they've moved on from that. I mean, they have become one of these industries that the cycles, there don't seem to be cycles anymore. I don't know if that's a good or a bad thing. We're going to find out. But the next thing we have to look at, because I do think there's some cyclicality to these, but maybe I'm wrong again. I don't know. But Goldman Sachs on the Homebuilders, they upgraded Lennar to buy. They downgraded DHI to neutral. Now, what I'll say about the Lennar, and I'm not looking to beat up Goldman Sachs, but they upgraded it to buy, I think, from neutral. Well, we're going to take a look at a chart in a second. The average price target for Lennar is about $123 or so. Average price target on DHI is about $118. But we're going to look at a Lennar chart right now, Carter Braxtonworth, and I'll say to Goldman Sachs, where have you been? I mean, this is the Homebuilders. This is the Homebuilders ETF, and you're going to overlay it with Lennar and DHI. But if you look at Lennar, for example, I mean, this stock is, to your point, it's been lower left, upper right. I'd say Goldman Sachs, thanks for nothing, CBW.
I'm with you on that. And also I mean, look, it's the job, right? You've got to try to impute insight, even if you don't have any, some people do, that you've done a lot of work and that you've made a judgment. This one's good, that one's bad, an upgrade or a downgrade. But you can just see, if you didn't know those were the stocks that we know they are, if I just said, look at the three colors, which one do you want? Which one don't you want? You're like, I think they look the same. Well, that would be the answer. They do look the same. So making a judgment, I like this one, I don't like that. Okay, sometimes there's a British expression, too clever by half. It's the same trade.
I love that, too clever by half. I wish I was clever, period. But look, it doesn't, again, I'm not trying to beat up Goldman Sachs. I mean, a lot of times they get it wrong. This is the Homebuilder ETF, the XHB. This, again, looks hauntingly like some of the charts we've just shown you. But again, this lower left, upper right, this uptrend's intact. We traded through that horizontal line, which was resistance. We're retesting it now. Stands to reason that maybe we'll test the uptrend and bounce. What are your thoughts here, Carter?
Well, again, and the point of sort of having the depictions over and over, when we say, wait, you're just drawing the lines the same way, because I'm not drawing the lines. The lines draw themselves. And what we know is this kind of setup repeats. It could be a currency, it could be a stock, it could be an index, it could be an ETF that's Homebuilders, or an ETF that's regional banks. The point is, breakouts are important, and false breakouts are equally important. At a minimum, I would think you fall back to the upward trend line that's been in effect.
Yeah, I agree. And I think that probably gives you a shot in some of these home builders like Lennar we just talked about, which, by the way, I think it's probably headed to that 122 or so price target, but I don't think it goes there in a straight line. Now, I was able to meet this next individual in person the other day. We did a conference call. I'd never met him before. It's like, for me, it was like meeting Mickey Mantle. But this is our one for the road, and this is our guy, Butters, who, by the way, we're going to see live next week. His earnings insight. Dan, Nathan, I know you sort of pick these apart and you parse through them. You're always fascinated by Butters' work. Talk to me about this.
Yeah, I've read his earnings insight blog for years and years before we had this relationship with him. So I really enjoy reading it each week, and I enjoy the preview that we get. And so he's talking this week about bottoms up EPS estimate for the S&P 500. Calendar 2022 is coming in. I think consensus is around $222, right? So, Guy, what do? You take where the S&P is trading right now, around 45.50 or so. You divide by that consensus estimate, and you get about a multiple about 20.5 times. Now that seems okay when you think about some of the biggest names in the S&P 500. You think about the top two names make up 12%. Microsoft and Apple make up 12% of the S&P 500. Throw on the next four names, it's about 25% of the S&P 500, and all of those stocks trade above a market multiple of about 20.5 or so. So there's a lot of stocks that are trading probably at multiples that are not sustainable if you're willing to give premium multiples to the big dogs, the ones that keep growing and putting up those earnings. But here's the thing, and I think this is a great point by Butters. He's saying on average, over the last 25 years, the consensus estimate heading into the year is usually about 7%, a bit too aggressive, right? So if you take that down, you get like a 205 number. The multiple seems okay, it seems fine here. I guess the point that we have to start, and this is why we spend a lot of time talking about interest rates, if interest rates are in fact going higher, then the multiple on the S&P is likely to be lower. So we'll continue to track this. We appreciate this from John Butters. Carter, do you have anything to say on the overestimation of S&P earnings estimates, especially at a time where if the Fed really is going to be a bit more aggressive on their taper, and maybe rate hikes come sooner, one of the fears is that it will choke growth a little bit, and then you will see S&P earnings hit.
The key is that overestimating earnings. Now, why would that be? It's been going on for more than 25 years. It's going on for 100 years. And here's why. If you're paid to analyze a stock, they call you an analyst, and you're going to keep saying it's going down, no one likes the bear. Do you know that of 40,000 buy or sell judgments for the S&P 500, because the average stock's got 20, 30 analysts, whatever it might be, only 5% of stocks are rated sell. Now, why would that be? Because No one wants to offend the company, offend the IR department. They won't get access to the junket the next time, or the special cruise to go check out the factory. So what they do is say hold, but they always overestimate. It's the job. It's called the sell side. They're selling. And so it always gets revised back.
Well, as I mentioned earlier, we have gone from X on the calendar to Z. We're in December. Thank you, Carter Worth. As always, thank you, Dan Nathan. Market Call 2022 Outlook, December 8th, noon, live. We're talking earnings, energy, and ESG. Join us for a live 30-minute discussion on those three key themes, sponsored by FactSet. Dan and I will be joined by FactSet's best and brightest, Butters, Senior Earnings Analyst. It's like Cher. Elliot Karoom, Senior Product Manager at True Value Labs, and Catherine Miller, President at BTU Analytics. I want to thank our sponsors. I want to thank Liz Young, obviously Carter Braxton Worth. If you like the financial and data and earnings content shared during the market call, subscribe to FactSet's Insight blog at insight.factset.com to access more great content. Today's market call was brought to you by our presenting sponsors, three of them. FactSet, financial data and analytics powered by tomorrow. SoFi, get your money right, all in one app. And of course, Open Exchange, Dan Nathan, because as you know, as Carter knows, as Liz knows, and as I know, they manage virtual meetings that matter for the top companies around the world. We will see you next Thursday, December 9th for Market Call. Later.